Welcome, everyone. Today, we're doing something a little different.
No,
Yeah, we're still in the world of investing, of course,
of course.
but we're going to take a deep dive into a concept.
Okay.
It's crucial for anyone looking to build a solid financial future.
All right, lay it on me.
It's the difference between investment and speculation.
Ah, the age-old debate.
Exactly. And to guide us, none other than Benjamin Graham.
The OG of value investing.
You know it. His book, The Intelligent Investor, is like the Bible for serious investors.
Published in 1949 and still so relevant. It's amazing.
Right. It's crazy how timeless his insights are, into market psychology and all that.
It really shows you the power of understanding the fundamentals.
Absolutely. So Graham kicks things off by, drawing this clear line
Between,
investment and speculation.
okay, break it down for us.
So he says real investment, true investment, it involves deep analysis of a company.
Due diligence, right?
Yep. You got to focus on safety.
Safety of,
Your principal, your initial investment. And you expect a reasonable return, not like getting rich quick.
got it. Slow and steady wins the race.
Exactly. But here's the kicker. Back in Graham's day, stocks, they were considered speculative.
Whoa, really? That's wild.
I know, right? It shows how much things have changed. Today, everyone in the market's called an investor, but are they really?
That's the question, isn't it? Are they putting in the work or just gambling?
Exactly. Graham even shares this newspaper headline from 1962. It says, small investors bearish, they are selling odd lot short.
Hold on now, that's a head-scratcher.
Yeah.
How can a small investor be selling short? Isn't that super risky?
You got it. Odd lots are those small stock purchases, less than 100 shares, and selling short, that's betting a stock price will go down.
So these small investors are making speculative moves. That doesn't sound very small investor to me.
It's a total contradiction, and that's Graham's point. When you blur the lines between investment and speculation, you get into dangerous territory.
You think you're being smart, but you could be setting yourself up for a big fall. It's like playing with fire.
It's so true. So how do we avoid this trap? How do we make sure we're actually investing, not just, rolling the dice?
Well, Graham has some ideas about that. He introduces this idea of the defensive investor.
Okay, so the defensive investor, what's that all about?
Basically, this is someone who's all about safety first. They're not looking for the hottest stock tip or trying to time the market.
They're playing it safe, huh?
Exactly. They want a portfolio that can handle the ups and downs, the market storms. And Graham suggests something surprisingly simple.
Let's hear it.
A big chunk of your portfolio, like
Yeah.
25% to 75%, put it in bonds.
Bonds. Really, some people might think that's a bit, boring, especially compared to all the exciting stuff happening with stocks.
I get it, but Graham is all about looking at the bigger picture. He compared stocks and bonds at different times and found, their attractiveness can really shift.
Like how?
He looked back at 1965. Stocks were yielding less than bonds back then.
So stocks weren't the better choice, even though they're usually considered riskier.
Not necessarily. By 1971, it was the opposite. Bonds were paying out more. It's not always black and white.
So you got to pay attention to what's actually happening in the market, not just follow the usual assumptions.
Precisely.
Makes sense. But what about inflation? Doesn't that usually make stocks a better bet than bonds?
That's the common wisdom.
Right.
But Graham's analysis challenges that a bit. It's more nuanced than people think. We'll dig into that more later in our deep dive.
Okay, so we've got the defensive investor playing it safe with a balanced approach. But what about those who are, a bit more adventurous?
Ah, you mean the aggressive investors. The ones who are aiming for those sky-high returns.
Yep. They're not afraid of a little risk, are they?
Not at all. They want to beat the market, get those above-average gains.
So what do they do? What are their strategies?
Well, they might try to time the market. Buy low, sell high, the drill. Or they might jump into stocks based on, the latest hype.
A hot new product launch, a surprise earnings report, that kind of thing.
Exactly. Or they might focus on companies they think will be big in the long run. The future Amazons and Googles of the world.
But didn't Graham have some doubts about these strategies?
Oh, yeah. He was pretty skeptical. He argued it's really hard to consistently predict what the market, or even a single company, will do.
So even if you're right about a company, the market might not agree with you.
Exactly. Your insights might take years to play out, and not everyone has that kind of patience.
So what's the secret sauce then? How can an aggressive investor actually beat the market if these common strategies are so unreliable?
Well, Graham's insight here is pretty interesting. He suggests that the best strategies, the ones that really work, they're often not the popular ones.
So you got to think outside the box.
Exactly. He advocates for what he calls the quest for undervalued securities.
Undervalued securities, huh?
These are companies that, for whatever reason, the market isn't giving enough credit. They're trading for less than they're really worth.
So if you can spot them, there's potential for big gains.
That's the idea. But it's definitely easier said than done.
I bet. It's like finding a needle in a haystack.
It takes a lot of work, a lot of analysis, a lot of patience. You have to be willing to go against the grain.
So it's not for the faint of heart.
Definitely not. But Graham has a whole bunch of strategies and tools for finding those hidden gems. We'll dive into those more in later chapters.
I can't wait. But for now, I think the biggest takeaway is understanding this fundamental difference between investing.
And speculating.
Yep, it's the foundation for making any sound financial decision.
It's all about knowing what game you're playing.
Right.
Mm.
So before we move on, let's just quickly recap what we've covered so far.
All right, get me.
We talked about Graham's big distinction between investment and speculation.
The two sides of the coin.
We met the defensive investor, who's all about safety and balance.
The steady eddy of the investing world.
And we touched on the challenges and the potential rewards for those aggressive investors.
The risk takers, the market beaters.
But before we dive deeper into Graham's world, we want to leave you with a question.
A good one, I hope.
Think about everything we've discussed. What kind of investor do you see yourself as? More defensive or more aggressive?
A little bit of both, maybe.
It's worth pondering. And we'll pick up this conversation next time as we continue our deep dive into the intelligent investor.
Yeah, it's a good question to think about. Figuring out what kind of investor you are is, well, it's like step one.
Totally.
Yeah.
Got to know yourself before you jump into the market, right?
Exactly. Speaking of which, let's get back to those aggressive investors, the ones aiming for those market-beating returns.
Right, those folks. We were saying Graham wasn't totally sold on their methods.
Yeah, he had his doubts. You see, he broke down their typical strategies into three main categories. Trading in the market.
Okay, like trying to time the market.
Exactly. Short-term selectivity.
Picking companies based on like immediate good news.
Yep, that's the one. And then long-term selectivity.
So betting on those future superstars.
Right, and he kind of took each one apart, showed why they're not as foolproof as people think.
Okay, so let's start with market timing. That's the classic buy low, sell high everyone talks about. Is it really possible to do that consistently?
Well, it sounds great in theory, right? But Graham argued it's basically impossible to predict those market swings perfectly.
So no crystal ball for timing the market.
Nope, no magic formula. He thought trying to do that was more like, well, speculation than real investing.
More like gambling than investing.
Exactly.
Okay, what about short-term selectivity? Picking companies that are, about to pop with some big news.
Yeah, that's tempting. But Graham pointed out that by the time that news is public, it's often already reflected in the stock price.
Oh, so it's already too late to cash in on it.
Pretty much. There are so many people watching, so many analysts crunching numbers, that any edge you think you have is probably gone.
Makes sense. It's like trying to buy a winning lottery ticket after the drawing's over.
Perfect analogy.
Okay, so we've ruled out timing the market and chasing short-term news. What about long-term selectivity? Picking those companies that will grow and grow over time.
That sounds more like what Graham would approve of.
Right, but he threw some cold water on that too.
He did. He said even predicting long-term trends is really tough. You never know what's going to happen in the business world. Take airlines, for example.
Oh, yeah, those were considered a sure thing back in the day, right?
Everyone thought air travel was going to explode. But Graham saw the risks, the volatile earnings, the debt. And as it turned out, well, the airlines have had their fair share of problems.
So even picking those future superstars is tricky.
Yep. The market doesn't always agree with you. Even if you're right about a company's potential, it might take years, even decades, for your vision to play out.
So patience is key.
Absolutely. And that's where Graham saw the real opportunity for aggressive investors.
Oh, how so?
Instead of following the crowd, chasing the latest hot stock, he said, you got to be a contrarian.
Go against the grain.
Exactly. Look for those hidden gems that everyone else is ignoring. The undervalued companies.
Right, those bargain issues he talked about. But how do you even determine if a company is undervalued? It seems so subjective.
That's the challenge, isn't it? It's where the art and science of investing come together. You need a deep understanding of financial analysis. You got to be able to dig into the numbers, see through the hype, figure out a company's true earning power.
So, no shortcuts here. It takes real skill and work.
Absolutely. And even then, there are no guarantees. But for the aggressive investor who's willing to put in the effort, well, that's where Graham believed you could find those market-beating returns.
So, it's like being a detective, right? Looking for clues, piecing together the evidence, trying to solve the mystery of intrinsic value.
And that's a great way to put it. It's not just about glancing at the stock price. It's about understanding the whole story behind the company. Its financials, its management, its competitive landscape.
And Graham provided a whole framework for doing that, right?
He did. A whole set of principles and techniques for analyzing companies, managing risk, and building a portfolio that aligns with your goals.
So, it's not just about being aggressive or defensive, it's about being intelligent.
Exactly. It's about being thoughtful, deliberate, and making decisions based on logic and analysis, not on emotions or hype.
We've talked about the analytical side a lot, but I think it's interesting how Graham also emphasized the psychological side of investing.
Oh yeah, that's crucial. He knew that even the smartest people can make bad decisions if they let their emotions get the better of them.
It's easy to get caught up in the excitement, the fear, the greed, all that.
Absolutely. That's why he stressed the importance of having a disciplined temperament,
Hmm.
one that can handle the ups and downs, the inevitable market swings.
So, how do you develop that kind of temperament? How do you stay calm and rational when everyone else is freaking out?
That's where Graham's principles come in. Things like margin of safety.
Right, that buffer between the price you pay and the intrinsic value, like a cushion, just in case.
Exactly. It's your protection against the unknown. Because even the best analysis can't predict the future with 100% certainty.
So, margin of safety, disciplined temperament, this is all starting to paint a clearer picture of what it means to be an intelligent investor. But I still keep coming back to this idea of intrinsic value. How do you actually figure that out? It seems so, well, slippery.
I get it. It's a complex concept. And to be honest, there's no one-size-fits-all answer.
So there's no magic formula for calculating intrinsic value.
Nope. It's a combination of art and science. But Graham does offer a lot of guidance. He dives deep into financial statements, analyzes management teams, evaluates competitive landscapes.
So it's about doing your homework, really digging into the details.
Exactly. He stressed that it's not a quick process. It takes time, careful study, a real understanding of how businesses work.
It's not just about skimming the headlines or listening to the talking heads on TV.
No way. In fact, Graham believed the stock price itself is often the least important factor when you're trying to assess a company's worth.
Wow, that's pretty radical. Most people just look at the price, right?
They do. But he wanted investors to look beyond those short-term fluctuations, to focus on the underlying fundamentals of the business.
Okay, so where do you even begin? How do you start to unravel this mystery of intrinsic value?
Well, Graham always started with the balance sheet. He believed a company's assets and liabilities could tell you a lot about its health, its potential.
So things like cash, inventory, debt levels.
Yep, and how much profit the company is generating. These are all clues to how strong the business is, how much value it can create for shareholders. We'll dig into all of that more in a bit.
Sounds good. I'm ready to get my hands dirty and start analyzing some balance sheets.
That's the spirit.
I'm getting it, slowly but surely. It is a lot to take in, though, all this financial stuff.
I hear you. It can feel like a whole new world, especially if you're just getting started.
Exactly. But you're right, Graham's principles are more like guidelines, right? Not strict rules you have to follow to the letter.
Exactly. You got to adapt them to, well, to your own situation, your goals, how much risk you're comfortable with.
It's not one size fits all.
Nope, not at all. Investing is personal. It's
Yeah.
about finding what works for you, building your own philosophy.
Your own path makes sense. But I do have one more question about those two approaches. You know, defensive versus aggressive. Do those labels always hold up in the real world? Or do things get messy sometimes?
Oh yeah, things definitely get messy. Graham knew that. He said there's no hard line between those two. It's more like a spectrum.
Yeah.
You might be mostly a defensive investor, but then sometimes a really good opportunity comes along.
One you don't want to miss.
Right. And you might have to, be a little bolder than usual.
Step outside your comfort zone.
Exactly. Or, on the other hand, you might be more of an aggressive investor, but you realize, hey, the market's looking shaky right now.
Time to play it safe for a bit.
Exactly. It's about being flexible, adjusting to whatever the market throws at you.
So it's not about being stuck in one box. It's about being dynamic, making smart decisions based on the situation.
Exactly.
And that makes me think, Graham wrote this book way back in 1949.
A long time ago.
The world's changed so much. Technology, globalization, the financial markets are so complex now. Do his principles still hold up?
That's the big question, right?
Yeah.
And I honestly believe they do. The specific tools and techniques, yeah, those might need some tweaking to fit today's world. But the core principles, they're timeless.
Why do you think that is? What makes them so enduring?
Well, they're based on logic, on a deep understanding of how people behave. And they take a long-term view. They're not about getting rich quick schemes.
They're about building wealth slowly and steadily, riding out those market storms.
Exactly. So even though the world has changed, human nature hasn't changed that much.
We still get greedy, we still get scared.
We sure do. And Graham's principles help us navigate those emotions, make rational decisions, even when the market is going crazy.
So what are some of those timeless principles that we should always keep in mind? The ones that will help us be intelligent investors in any market.
Well, first and foremost, the focus on intrinsic value. That's the cornerstone of everything.
Right, that idea that an investment should be based on what a company is truly worth, not just what its stock price is doing at any given moment.
Exactly. It's about seeing past the hype, the noise, all the distractions, and understanding the real value of a business.
It's about being a detective, not a gambler.
That's a great way to put it. And then there's the principle of margin of safety. That's your protection, your buffer. It's about acknowledging that we can't predict the future perfectly.
So even if our analysis is a little off or something unexpected happens, we've got that cushion.
Right. It's about managing risk, not just chasing returns.
Yeah.
And then there's the importance of patience and discipline. Graham knew that investing is a long game.
It's not about getting rich quick. It's about letting your investments grow over time.
Right. It's about being in it for the long haul, staying the course, even when things get bumpy.
And resisting the urge to jump in and out of the market, trying to time those ups and downs.
Exactly. It takes discipline, but that's how you build real wealth.
I'm really struck by how Graham's philosophy addresses both the analytical and the psychological sides of investing.
It's true. He understood that being a successful investor is about more than just crunching numbers. It's also about mastering your emotions, thinking for yourself, not getting swept up in the crowd.
It's about being independent, being rational, being in control.
Exactly. And those are qualities that will serve you well in all areas of life, not just investing.
This has been such an eye-opening conversation. I feel like I'm starting to see investing in a whole new light. But before we wrap up, I have one last question. We've talked a lot about what makes an intelligent investor, but I'm curious, what are some of the common mistakes that even smart people make? What traps should we be watching out for?
That's a great question. And it's important to remember that even the best investors can slip up. No one is immune to those psychological biases that can cloud our judgment.
So what are some of those biases that can trip us up?
Well, overconfidence is a big one. It's easy to get cocky when you've had some success, to start thinking you're invincible. But the market has a way of humbling us all.
So it's important to stay grounded, not let those wins go to our heads.
Exactly. You got to remember that luck plays a role too. And be willing to admit when you're wrong.
Humility is key. What else?
Another common trap is anchoring bias. That's when we get fixated on a certain number, like the price we paid for a stock, and we make decisions based on that number, even if it's no longer relevant.
So we're stuck in the past, holding on to a losing investment because we can't let go of that original price.
Exactly. It's important to be flexible, to adjust our thinking as new information comes in.
To be present, not stuck in the past.
Exactly. And then there's confirmation bias. That's when we only look for information that confirms what we already believe.
So we're filtering out anything that challenges our view, even if it's valid.
Right. It's like we're living in an echo chamber. To be a good investor, you have to be open-minded, willing to consider different perspectives, even if they make you uncomfortable.
To be willing to change your mind. So how do we avoid falling into these traps? How do we overcome these biases?
Well, awareness is a big step. Just knowing about these biases can help us catch ourselves when we're starting to fall into those patterns.
So knowledge is power.
It definitely helps.
Mm-hmm.
But it's not enough. We also need to develop strategies for countering these biases, like seeking out diverse perspectives, talk to people who disagree with you, read things that challenge your assumptions.
Get out of that echo chamber.
Exactly. And it helps to have a trusted advisor or a group of fellow investors who can give you honest feedback.
A second set of eyes, someone to point out our blind spots.
Right. And sometimes you just need to slow down. Don't rush into decisions. Take your time. Think things through carefully.
Don't let your emotions drive the bus.
Exactly.
Well, this has been an incredible journey. I feel like I've learned so much, not just about investing, but about myself as well.
I'm glad to hear that. And remember, this is just the beginning. Being an intelligent investor is a lifelong process.
There's always more to learn, more to explore.
That's the beauty of it. And the more you learn, the more confident and successful you'll become.
Well, that's all the time we have for today's deep dive into Benjamin Graham's The Intelligent Investor.
It's been a pleasure diving in with you.
We've covered a lot of ground. Investment versus speculation, intrinsic value, margin of safety, discipline temperament. It's a lot to take in, but we hope it's given you a solid foundation for building your own intelligent investment strategy.
That's what we're here for.
And remember, this is just the start of your journey. Keep learning, keep exploring, keep challenging yourself to become a better investor.
And most importantly, happy investing.